Today, we're going to cover the latest around the blocked $4.9 billion ANZ-Suncorp deal and how it impacts Australia's banking competition. Plus, we're going to uncover the soaring refinance trends of 2023 and what it means for you. Jaden, starting off on the top, tell us a bit more about this ACCC and why they rejected the ANZ and Suncorp merger.
Yeah, so the Australian Competition and Consumer Commission has said no, they're not going to allow, at this point in the current shape, the Suncorp-ANZ merger. So what was going to happen was ANZ was effectively going to acquire Suncorp's banking license. Suncorp is an insurance business, also a banking business, so they're going to split it. Suncorp was going to continue as an insurance business. ANZ was going to get the branches, the banking license. They were going to get the license pretty much for 3 years. Then ANZ could kind of do what they wanted with it. But the ACCC was pretty much said they're concerned that it's going to hamper, the supply of home loans nationally. It was potentially going to get, affect regional areas of Queensland where Suncorp's prevalent in the sort of agriculture, commercial space. And it said it's potentially going to actually reduce competition of a lot of the second tier banks, making it harder for, the likes of Bendigo, Adelaide Bank, those providers when there's the big four banks become even bigger. So the proposed deal was actually announced back in July 2022. So it's been, almost 12 months of working in background. And this was one of the last sort of hurdles they're all pretty confident it's going to go through. And this has happened today.
Yeah, exactly. And it's been frustrating for both sides, ANZ and Suncorp, because Suncorp really want to take the deal. They're keen to consolidate their banking arm. As Jaden said before, they want to concentrate on their insurance, particularly because the insurance business is becoming harder with all the natural disasters and everything that's going on. They really want to focus on their insurance and no longer have to worry about banking, home loans, all those sort of things. ANZ's keen to take them on because their market share has been falling behind the other three big banks. But Bendigo Bank and Adelaide Bank, the two lending banks that are really keen to take over Suncorp, have been fiercely fighting the ACCC, saying that if ANZ take over Suncorp, it's going to reduce competition in the marketplace. Bendigo is actually saying Suncorp Bank should be sold to them because it would create more competition. And this is one of the things that's causing a real rift between the ANZ-Suncorp deal and slowing things down. And if you do find value in this video, please consider doing me a little bit of a favor and hitting that subscribe button, as it really does help out the channel. And for all the supporters out there, we thank you for being subscribers and watching our content, because it helps us and gives us inspiration to continue to create more content. So as of June 23, ANZ held about 13.3% of the mortgage market, while Suncorp had 2.4% and Bendigo only 2.8%. And this is where, Jaden, we see Bendigo really want to consolidate, really doubling their loan book. What does this mean? I know you were working at Bankwest when they went through the merger. Where do you think really it makes sense for Suncorp to go?
Yeah, so what a lot of the sort of regional banks were saying, ANZ said, well, we're going to keep all the jobs, in Queensland at the moment that are here. We're not going to start closing branches yet. We're going to try and keep as many people on the ground. But yeah, I was working at Bankwest during the GFC, basically, where it was owned by HBOS, like a bank in Scotland. They went into a lot of financial trouble. So the Commonwealth Bank actually acquired Bankwest back then. And at the time they said, we're not going to close any branches. We're going to kind of keep the current footprint. Everyone's going to stay in their jobs. And over time, they've changed their tune. They've closed most of the branches on the East Coast. This is Bankwest. They're mostly in WA now. There's no more business banking, which Bankwest brought. So if you look at the industry as a banking whole, when Bankwest was independently owned, it was owned by an international bank. They had business banking, they had residential banking, they had consumer banking, everything there. And if you look at it today, it's pretty much a bank that's just a brand. It's Qantas's Jetstar, effectively. It's Bankwest as Commonwealth Bank's sort of low cost Western Coast provider at the moment. So if you look at the industry, are they providing competition? I guess in the home loan market, you could say they've got slightly different product offering to Commonwealth Bank. But if you look at over the last 5 years, would they provide more competition if they're an independent bank trying to go for independent margins? I think they would. So it's been the same for this Suncorp ANZ deal. They've sort of said at the moment, well, ANZ has said they're going to keep Suncorp as a separate brand. It's going to be, the Queensland brand, that sort of stuff. But they only had the license, well, if the deal still goes ahead, and if it still could, but it's looking less likely now. They only had the brand, the license for 3 years. So after that 3 years, what happens to that Suncorp brand? And that's been Bendigo's argument for this.
Well, and that's exactly where an independent expert that was hired by the ACCC that conducted a bit of an analysis on the merger said that the merger between Suncorp and Bendigo could be more beneficial to creating competition. And guess despite this suggestion, Suncorp's super keen to take this the ANZ deal because the potential deal is a cash deal. They have no strings attached. They can get out of the banking market and really not have to work around it.
Well, and it just gives the bank instant growth. It's like, just buying an existing business. You take your existing loan book, your existing depositors, and you grow it by, a large percent. You get an extra exposure in Queensland. ANZ obviously based out of Melbourne. They've got really great impact. They've got great exposure down in Melbourne. Some of the, the southern states there, but not so much in Queensland, interestingly, from what we've heard from the figures here. So Suncorp, that business could be a real win for them.
And as Jaden talked about with Bankwest, what we found when Commonwealth Bank took it over, they consolidated a lot and really reduced their Bankwest presence in business banking and their branch network. But if we look at Westpac, so Westpac took over St. George, the Bank of Melbourne, the Bank SA brands. It feels like the St. George, the way Westpac used the St. George brand was that they did use it to really expand and continue to grow and not really reduce their banking arms in the business sectors, even their branch network. So maybe this ANZ-Suncorp deal might have some silver lining and they might not go down the CBA path and they might replicate what Westpac did. And no doubt ANZ is super keen to get this deal across the line. They have lost a lot of market share in recent times. So having a brand like Suncorp will allow them to compete both not only against the bigger banks, but in the second tier. Definitely will be interesting to see what happens here. Guys, leave a comment down below as to what you think might happen and what do you think is going to be best for the consumer, because ultimately that's all that matters. Now, moving on, we have seen mortgage refinance numbers hit a record recently, and we saw in 2003 there's been record refinancing and it's risen by 13% nationally recently. Jaden, walk us through what's going on. Why is there so many refinances? We've seen 12 rate rises in the last sort of 13 months. 4% increase since May of last year. What does this mean to borrowers and why are so many people looking to refinance?
Yeah, obviously there's the mortgage cliff that's been well publicized. 40 to 50% of all fixed rates were coming off this calendar year over the next few months. So there's a lot of people that are reverting back from 1.99, 2.99%. The current rate is 5-6% and wanting to look at a better deal. The second reason is, as we find, which is unfortunately, it's not a great situation, but new customers to the banks tend to get better deals than their existing ones. It's like your mobile phone plan. If you've been with Telstra Optus for a couple of years, the new plans that are coming out today with the new iPhones might be cheaper, might get more data, etc. It's the same with your home loan provider. And the third one is just the cashbacks. Like they have all, in a lot of cases, they've been sort of tailed back. ANZ is actually still doing one at the moment, but there were a lot of cashbacks earlier in the year. There's money flowing around. It's kind of easy to refinance. But obviously, there's been a change even the way they assess things. So that's also opened up some avenues. What's happened there with refinances?
Yeah, definitely. And I think the refinance, the massive numbers of refinances, a 13% increase, has a lot also to do with the huge number of fixed rates ending. A lot of people, I think it was about 40% of loans written in 2020 were fixed rate mortgages. These are all ending. So they're all coming off. A vast majority of them have started to roll off in last month, July, this month, August. So we're actually seeing a lot of those refinancing people that were fixed in that are wanting to get off that. But to your point, Jaden, it is becoming easier. There are a bunch of banks that are making the serviceability assessments. These are the assessments the banks take into account when looking at your application, whether you can get the loan or not. They have relaxed them. So previously, they used to do an assessment where they add 3% on the rate that you're paying. So if you're paying a 6% rate, they're actually assessing your ability to pay a 9% rate. They've changed that. Now they're only putting 1% for refinances. So that makes it a lot easier.
Yeah, so if you feel like you're a mortgage prisoner, if you have maybe spoken to your bank or broker and they've said you can't refinance, a couple of tips that I'd suggest considering and looking into are, firstly, like Nathan said, there are banks that will accept a lower buffer rate. So instead of doing 3%, they'll do 1%, and it can potentially help you move banks. The second thing I'd consider and look at are some of your other debts. One thing we are finding it's impacting even people that are refinancing that just had no impact a few years ago is your HEX, is your credit card, even is just tax deduction, deductions on your pay slip. If you're making mandatory contributions to your super, things like that we can tell the bank and say, well, Nathan's making extra voluntary deductions to his super. He could stop that if he chose to, and the bank will add that back and help with your capacity. And the third thing that you can check out is potentially loan terms. If you've had your loan for 15 years, if it's an investment property, they're actually assessing your loan based on a 15-year term at 9 to 10% interest rates. So it can be pretty crazy. So potentially, if it makes sense, and you need to do the figures, so it's not going to make sense for everyone, but you could extend that to a 20, 25-year loan term, and it can help get across the line.
And this is where working with the mortgage broker like ourselves can help. We can assess your situation, we can review the banks and the options. There is a bunch of cash rates, cashback still available at the moment where you can get $4,000 to move your loan across. And you can reach out with us directly here at Hunter Galloway at huntergalloway.com.au. Visit our website, fill in the contact form, or call us on 1300 088 065. Guys, as always, thanks for watching, and we'll see you next time.